China's banking sector is on strike as lending enters a record-breaking contraction.
Expert Jeff Snider of Eurodollar University analyzes this freeze alongside other top financial minds.
See why 5.25% yields are struggling to compete with a massive artificial intelligence bubble.
We also reveal the specific pivot number that will decide the fate of the technology rally.
The stock market hit a new record this August 15th, 2026, but there is a sense of being stuck.
Exactly. Joseph notes that while the S&P 500 eked out a high, we are likely stuck for a few days due to options expiry.
So is this just summer doldrums or a sign of a blow-off top?
It could be a blow-off top, especially with traders aggressive on calls, but the real action is in the bond market.
The core of the discussion today is the long bond, which Joseph says is behaving very poorly.
Right. The yield is around 5.25%. It has been marching higher relentlessly over the past few months.
But haven't the inflation numbers been coming in lower than expected?
That is the concern. Yields are rising, even when the data suggests they should be falling.
Last week, we saw benign CPI and soft retail sales. Why didn't yields stay down?
They dropped initially, but then immediately retraced. It tells us that the market fundamentally wants yields to go higher right now.
Even with retail sales suggesting economic weakness?
Yes, even then. The market is ignoring weak data in favor of a higher yield trend.
Is there a global factor pulling these U.S. yields up?
Joseph points to Europe and Asia. The ongoing war in Iran is hitting distilled products like diesel and gasoline fuel prices hard.
I thought crude oil was well behaved, though.
Crude is fine, but refinery capacity is low. Gasoline futures are marching higher, and that energy shock is spilling over into global bonds.
Why aren't people buying 30-year bonds at 5%? That sounds like a great deal.
It's hard to compete with the AI bubble. Why lock in 5% when you think you can double your money in tech stocks in a few months?
So the bond market needs the equity market to crack before it sees a real fight to safety. When does the trend finally flip for bonds?
Joseph predicts that when the equity market eventually cracks, we'll see a massive flight to safety.
And that would force the market to price in more Fed cuts?
Exactly. A negative wealth effect from stocks would finally give bonds the bid they need.
Could the government step in if the long bond keeps trading poorly?
There's a possibility. Joseph mentions the Treasury has opened the door to changing coupon issuance sizes.
Like what Japan did a few years ago?
Precisely. Cutting the supply of the 30-year could put downward pressure on those yields.
Joseph's final takeaway is that we shouldn't rely too much on old statistical models.
He's very clear. This isn't physics, it's psychology. Different lenses, like real yields and term premiums, explain why investors want more compensation now.
So we're in a new regime of uncertainty?
It certainly seems so. Between the Fed's vague reactions and global conflict, the long bond is the ultimate tell of that uncertainty. Jeff Snider is highlighting a major inflection point in China where bank lending has entered a record contraction.
That is right. In July 2024, new loan flows actually turned negative, which is something we have not seen in the modern data series.
So instead of the usual growth, banks are actually pulling money out of the system?
Exactly. It is a sign that the centerpiece of the Chinese economy, the banking sector, is essentially on strike.
Why would banks stop lending if the central bank is trying to stimulate the economy?
It is what Snider calls depression economics. The banks are de-risking their balance sheets because they see massive hidden losses in real estate and local government debt.
So they would rather take a tiny yield on a government bond than risk lending to businesses?
Precisely. They are prioritizing safety over everything else, which effectively kills the credit engine for the whole country. The mainstream media keeps saying that lower rates in China are stimulus. Snider disagrees.
He invokes Milton Friedman's interest rate fallacy, arguing that low rates are actually a reflection of low inflation expectations and weak growth.
So when we see yields falling, we should be worried instead of excited?
In this context, yes. It confirms that the financial system recognizes the underlying economic rot.
Now, Snider points back to late 2018 as a pivotal moment he calls the landmine.
That is when Chinese banks first significantly pulled back on risky behavior, shifting toward managed decline.
And the government has been trying to cycle through stimulus ever since without success?
Exactly. Every mini cycle of stimulus since 2018 has failed to produce a real recovery.
Beijing is suddenly enforcing long-dormant tax laws on capital gains and offshore wealth.
This is a desperate move to raise revenue for local governments that can no longer pay their bills or employees due to the credit freeze.
So they are going after the super rich because the usual land sales and loans have dried up?
That is the reality. It shows how dire the fiscal situation has become for local authorities.
Based on the bank data, what does the outlook for the next few years look like?
Snider notes that the charts for 2025 and 2026 show an accelerated downturn that is already baked into the system.
Does this mean we could see a total breakdown of the current economic model?
It suggests that the managed decline might become a disorderly decay if they cannot find a way to restart credit flows. If the tax crackdown does not work, what is the next step for Beijing?
The analysis suggests we could see more extreme measures, including strict capital controls to prevent money from leaving the country.
So the tax purge is just the beginning of a larger crackdown?
It is a likely prelude. As the situation worsens, the state will feel forced to take even more control over every yuan.
How should we track this crisis as it unfolds?
Watch the 10-year Chinese government bond yield. If it keeps dropping, despite what the central bank says, the panic is still growing.
So the bond market tells the truth while the officials try to maintain a brave face?
Exactly. The yield is the ultimate signal of whether banks are still on strike and seeking safety. Matt deWolf is tracking a significant shift in the Middle East today as the 60-day ceasefire has officially expired.
The news is moving the needle because Iranian officials are now stating they have shifted from a defensive policy to a fully offensive one.
We saw a brief blip of volatility on that headline, but does the market actually care? Or is this just more geopolitical noise that will be faded?
The core thesis today is that the market is currently digesting its massive rally through time rather than price.
We are looking at the ES futures flagging out right at the previous all-time highs of 7,820.
So unless we see a deep pullback, the momentum is still technically bullish, even if it feels like we are standing still for now.
Interest rates are becoming a headwind again, with the US 10-year yield pushing back toward 4.7%.
That move is tied to crude oil firming up toward $83 as the Strait of Hormuz situation develops.
Higher rates are definitely a drag on risk appetite, especially for the high beta technology names we usually follow.
On the tech front, NVIDIA and OpenAI have committed to a massive infrastructure deployment plan.
The deal involves substantial deployments through 2030, with OpenAI paying the lease on the hardware.
It seems the AI trade is still finding fresh legs with these high-level corporate partnerships.
The Nasdaq is at a critical pivot point, and Matt is eyeing one specific number for the bulls to defend.
That number is 30,075. If we stay above it, the breakout is valid, but otherwise we are back in the junk drawer.
The junk drawer is where you get those messy and volatile moves that can really prick your portfolio.
While we are in a bull flag now, Matt warns of a potential bearish pattern if momentum fails to return this week.
If we do not break out soon, this could turn into a head and shoulders over the next 5 trading sessions.
With the economic calendar looking relatively quiet this week, we are really just waiting for the big technology names.
NVIDIA earnings next week are the primary event that could finally break this sideways range and provide direction. The game plan is simple, which is to watch 30,075 on the NQ and 7,820 on the ES.
And keep an eye on those yields, because if 4.7% breaks to the upside, the equity rally might be in trouble.
And that's the full rundown for today. Want the final verdict, where these experts agree and where they clash head-to-head? It's in the video linked below.
Give this a like if it saved you time, and subscribe so you don't miss tomorrow's breakdown.